Thank you for your kind introduction. I'm Miyagawa, the professor at Gakushu University and serving also as a faculty fellow at RIETI. My name is Miyagawa, as was introduced. Now we would like to start the panel discussion. The title of the panel discussion is After the Global Financial Crisis, the Growth Strategy After the World Financial Crisis. Now, after this crisis, advanced countries and developing countries, in both countries, economic growth suffered. Each country, in order to recover the economic growth, has been making efforts. The keynote speeches were given by the two speakers, and building upon that, looking at each country or each region. What is the undertaking for the economic growth? We would like to really delve into details. Professor Jorgensen, as he mentioned, growth strategy is not really a common worldwide, but if we use the expression of improvement of productivity, not just in Japan and in Europe, but including the United States, many countries are trying to improve their productivity. I think at least it's possible for us to make that statement. So through productivity improvement, stable economic growth. What are the issues? How we should overcome those problems or issues? From 5 discussants, we would like to listen to their opinion and have a discussion. As for the timetable, we would like to listen to each one of the panelist member of the panel, spending about 10 minutes each. First, the Professor FUKAO of the Hitotsubashi University, looking at the Japanese example. The issues of the low growth in Japan, about the growth strategy, I would like him to focus on that. Amongst the various countries in the world, Japan is a country that has been tormented by a low growth for a long time. So starting with Japan, and right next to Japan, a country that's likely to have a huge impact in Japan, the China and the East Asian countries. About the issues faced by China and East Asian countries, Professor Lau would share with us his insight. But in China, huge amount of NPL, non-performing loan, it's said to exist. So how China should tackle this NPL issues? I hope that he will cover that as well. We looked at China as just one example. The economic growth going forward, to achieve the economic growth. Amongst the important factors, there is finance, and as in the World KLEMS conference, it was mentioned quite frequently, trade structural issue. These two issues will be elucidated by 2 experts. First, about finance. What kind of a role will it play in the economic growth? Professor KIYOTAKI from Princeton University will share his view on that. And then after the world financial crisis, there have been major changes in the global trade system. Again, the expert in this arena. And then he is spreading this idea of new value-added trade. Professor Marcel from the Groningen University will share his view on this. So building upon this, regarding the global economic growth, what would be the future economic growth? In the conference board, Professor Van Ark is engaged in having an outlook for various parts of the world, and he will be sharing his view. So that's the first half of the panel discussion. In the second half, the issues of finance and the trade. How should we tackle these issues in the future? From each discussant, I would like to ask you to share your view. And at the very end, for stable growth, what would be the economic policies necessary going forward. I would like each and every one of you to address that. And the remaining time, we wish to use it to entertain questions from the floor. First, Professor Fukao from the University, Hitotsubashi University, please share with us your view on the Japanese experience. As was introduced, I'm Fukao with Hitotsubashi University. As Professor Miyagawa mentioned, Japan is really in a way a pioneer as a country in suffering from a long-term stagnation. What would be the lesson that the other countries can draw from Japan? As Professor Jorgensen mentioned, Lawrence Summers at the last IMF, he made this lecture, and amongst the advanced countries, there is this kind of idea for long-term stagnation in various parts of the world. In many advanced countries, the productivity increase for long term has been decelerating. And because of that, the investment opportunities have been declining, lower investment, the shortage of demand, and resulting in recession. Non-conventional financial policies can be utilized to keep the interest rate low, but that's likely to result in bubble in the case of the United States from the beginning of the 2000s. Maybe that's what happened in the United States. That's one argument, and it's probably likely to stay. And I think that's the kind of a concept of that particular argument. The principles, there might be some deceleration of the productivity increase. From the end of 1990s, this was already discussed. In that sense, Japan was actually going ahead of the rest, for 15 years or so. But something is different from 15 years ago. By industry sector productivity, that data was extremely limited. The stagnation of productivity was first discovered or pointed out by the Professor Fumio Hayashi, who was with University of Tokyo at the time. But that was about the productivity in the macroeconomics. It was not particularly by sector analysis. And there's a KEO database at Keio University. Professor Masahiro Kuroda and Professor Nomura created a very accurate database by industrial sector. However, it was not particularly disclosed, and it was not something that was updated every year. In that sense, Professor Jorgensen and Professor Van Ark and Professor Marcel Timmer, thanks to your efforts, the data set, the industrial level that allows us to analyze the world as a whole, and also the firm level the data is now added, which means that we have a new weapon compared with what we used to have 15 years ago. These experts are all in this hall in the United States and also in various parts of Europe. There are the experts who are doing that kind of work. So if all of us actually disappear from here for 5 or 50 or 10 years, the productivity, the research will not probably go ahead. And we really have that kind of a great pool of experts. First, I would like to share with the current status of the Japanese economy. And secondly, lessons from Japan's secular stagnation. You can see that the solid line going up, that's the potential GDP, according to Japan's Cabinet Office. Dotted line represents the actual GDP. As you know, January, March, there was a last-minute demand before the consumption tax hike, so the GDP gap. There was almost no lack of GDP. Consumer price index, prices have also increased. This was really the sort of front-loading consumption, so it may go down, but perhaps from deflation and the lack of demand, maybe we can actually end that period. But how to fill this gap from the investment saving balance while the saving is high but investment is low? So it is actually financed by this red line, the public finance, the deficit, but it cannot continue. The budget deficit cannot continue for a very long time. Can we really eliminate this problem of the lack of demand? It's still a big question. By ending deflation, create the mild inflation, but continue the low interest rate policy. By promoting investment, maintain the economy. That seems to be the government policy, in my opinion, but it could lead to a bubble. Extremely low interest rate or negative interest rate could result in the bubble. By improving productivity, investment, a wage increase should be achieved. Ideally, that should be pursued. As I said here, and Professor Jorgens already pointed out these matters, but IT investment is low, and there's a low labor market rigidity in Japan. Many measures can be implemented here. But the government, with growth strategy, are trying to address these issues. Professor Jorgens made such an important point. For instance, in terms of adopting certain policies, how much productivity gain can we expect? In advance, such assessment should be done, but that's new. And post assessment is necessary after the certain measure is taken. And I know it's difficult, but there has been no attempt to do that kind of a post-facto assessment. Just bureaucrats come up with ideas, they make statements, and then they devise policies. And that seems to be the current situation in Japan. There's another thing I can share with you. Hard landing. There is an increasing danger of the hard landing. According to IMF, amongst the 36 countries, the developed countries, there's a lack of demand for 110 trillion. 2.2% of their GDP is estimated in Japan. It's almost zero. So lack of demand has already been solved in case of Japan. So what are we approaching to in Japan? Non-conventional financial policies was conducted with so much infusion of high-powered manner, but the long-term government bond rate is almost zero. So if there is a spreading of the inflation expectations, BOJ will be faced with a very difficult situation in terms of policy options. If the interest rate is kept low, then with this kind of a mechanism, there might cause hyperinflation. If the rates are increased, then huge capital losses might be suffered by investors and the banks, and going back to recession as a possibility. So by improving the productivity little by little, if profitability increases, then the exit mechanism could work, could function. But with low productivity and low profitability, if there are more expectations about inflation, it will be difficult to get away from this. And so much for the current status of the Japanese economy. So what are the lessons from Japan's secular stagnation? One, by lowering the real interest rate, promote investment. This cannot go on forever, because Japan tried to do that for 20 years. People say that there has been not so much investment, but given the decrease of the population, it has been done. But capital versus GDP, it has been going up. Compared with GDP, capital has accumulated, and with lower profitability. And this simply cannot go on forever. That's the situation Japan is faced with. So the profitability of asset must be increased, not just a low interest rate. Productivity must be improved, and profitability of the capital must be increased. That's one lesson. And second lesson, in the United States, for instance, the Lawrence Summers quoted Gordon's research. The innovation capability itself has been declining. That's one argument. But in the case of Japan, that's not the case in Japan. There are many reasons about what are the obstacles before the obstacles to the realized improvement of profitability. There are a lot of evidence. So it starts talking. It's not really about the innovation has decelerated. It's not something that God has given less the innovation. Something can be done and to improve productivity. Third, when there's a lack of demand, with public finance policy, fiscal policy, for instance, by building infrastructure, creating demand, perhaps can be found in some interviews on the Lawrence Summers. Japan did that, but Japan did it in a wasteful manner. On the x-axis, this is by prefecture, the per capita GDP is shown. In 2008, by prefecture, per capita GDP is shown on x-axis. On y-axis, this is the gross rate of return on capital. Correction, this is the per capita gross prefectural product and social capital stock per man-hour labor input. Y-axis, social capital stock per man-hour labor input. You can get an impression this is in a negative area when there are a lot of economic activities. The wealthy countries with lower input, with low input, but in poor areas there's a lot of input. So in order to realize the equality, the input was made. Now, savings did not decrease, and there was also lack of demand. But you can see the private savings and divided into corporate savings and household savings because of the aging society. Household saving decreased, but corporate savings kept increasing. Why companies are not paying dividend, but they are hoarding cash and assets? It's a very important issue when we address this lack of demand. That's one lesson from Japan. Another, Germany and China. They enjoy a high number of the current account surplus. And this can be described as the export of unemployment. In some developing countries, lack funding. So there's an imbalance of the current account economics. So this has to be addressed. And Japan has still suffered from various problems in this regard. And lastly, number 6, non-conventional policies, the exit policies from non-conventional policies. Japan might be the first country to experience the failure of having an exit. That concludes my explanation.
To ask Okay, so we'd like to ask Professor Lau to make a speech.
Thank you, Mr. Chairman, Mr. Nakajima, Mr. Fujita, Professor Jorgensen, ladies and gentlemen. It's a great pleasure and an honor to be here today, and I'd like to thank RIETI for inviting me to come to Tokyo. Today I'd like to talk about the prospects for East Asian and Chinese economies. 3 parts. First of all, I want to talk about the shifting center of gravity of the world economy and the partial decoupling hypotheses. Secondly, I want to talk a little bit about the advantages and disadvantages of East Asian economies other than Japan. Third, I'd like to talk a little bit about the prospects for Chinese economy, covering the fundamentals as well as the fact that it's demand constrained rather than supply constrained output, and finally, whether a hard landing is likely or not likely. We all know that the center of gravity of the world economy has been shifting. In 1970, East Asia, including Japan, was only 10% of world GDP. All right, and then you can see the red slice is China, the golden slice is Japan, and all the color slices is East Asia. And now in 2012, you could see that the color part has expanded to about 25%. And United States and Europe, Western Europe, has now become, roughly speaking, 45%. It's really a big decline. And this chart graph is quite clear using market exchange rate. The green line up there is East Asian share of world GDP. The golden line is Japan, and then the red line is China, and the light blue line at the bottom is South Korea. Okay, so it's really gone up from around 10% to 25% of world GDP, East Asia. This chart actually shows you the international trade in goods and services. Again, same idea. You can see that in 1970, it is actually around 10% of world trade. Japan has the largest slice in East Asia. By 2012, it's about 25% of world trade. And Japan's slice is very big, but Chinese slice is now much bigger. And then the Western Europe and North America, they have shrunk from 75% to now around 45%. So the trade has really shrunk in terms of the here. I know my time is limited, so I would go very quickly. One particularly interesting development is the rise in intra-East Asian trade. We know that 30 years ago, most of the trade would just go from East Asia to Europe or to America. But today, we find that 50% of the exports and 50% of the imports are intra-Asian, intra-East Asian. Okay, so that really explains a little bit. There's more global supply chain, but there's also a lot of demand in these countries now. They are not just manufacturing centers. They have become markets in their own right. Now, one of the things I want to convince you is the following: is that there's a partial decoupling of the Chinese and East Asian economy from the rest of the world. You look at this chart. This chart shows you the quarterly rates of growth of exports of selected East Asian countries. See, everybody fluctuates, and the red line is China fluctuates like everybody else. And you look at imports, same idea, it fluctuates everybody else. You can see the 97 and then the more recent 2008 fluctuations. But now you look at this chart with GDP growth, quarterly GDP growth. You can actually see the red line fluctuates, but it's relatively stable compared to others. Okay, the others, they actually go up and down, they can actually go negative, but this should show you that the China, being a very large continental economy, is actually relatively stable relative to whatever happens externally. Now, what are some advantages of the East Asian economy? The high savings rate, this we all know. If you have a high savings rate, you don't really have to rely on foreign capital, which is a huge advantage for East Asian economies, unlike Latin American economies. This actually is the saving rate of East Asian economies. The red line is China. The yellow line is Japan. But I think these savings rates do not really reflect the true situation, because I think in this computation, in fact, I know where Japan is converted, but basically R&D expenditures would be expensed as opposed to if they were actually counted as savings, it would have gone into savings rate. So it probably should have been higher. The same applies to South Korea and Taiwan. The principal sources of economic growth of East Asian economies will gradually evolve from the growth of tangible inputs such as capital and labor to the growth of intangible inputs such as human capital and R&D capital. And this is true of the experience of developed economies such as the US. Now, let's take a look at this chart. The blue line up on top is the United States. Okay, this is really a very simple chart. It's the number of years of schooling per person in the working age population. Okay, the golden line is Japan. You can see that Japan still ranks very high. And down below, the red line, very much below, is China. Okay, so it's still a long, long ways in terms of human capital. This particular simple measure, human capital, you could see the rest. And South Korea is actually catching up very fast in this chart. Similarly, you look at R&D expenditures as a ratio of GDP, and you could see that the golden line was Japan, way on top. And more recently, South Korea has overtaken in terms of percentage of R&D expenditure to GDP. The blue line has always been very high and steady. That's the United States, okay, around 2.53%. And down below, you have the Chinese line. The red line is probably going to approach a little bit above 2% this year or next year, somewhere along those lines. So it's still a long way. And I know that the Mr. Fujita presented patents, applications. This is patents actually granted. Okay, so the two things are very different. The blue line up on top is United States. You can see it is really still the highest, and it's running at 130,000 patents per year granted by the United States. Okay, and then the golden line is Japan. Japan is number 2 in the world in terms of number of U.S. patents granted. It's over 50,000 patents. Okay, still very strong. And it's above all the other economies. The red line down below is China. I mean, this is logarithmic scale, so you can see just down below would mean a lot. China is now running around 6,000 patents per year, granted. Okay, so but you can see the light blue line is really quite interesting. That's South Korea. South Korea is really going up very fast, and the light green line would be Taiwan. Now, what about the Chinese economy? First thing I want to say is that what is important for the Chinese to understand Chinese economic growth? It's been underpinned by 3 factors. One is a very high rate of investment enabled by a consistently high national saving rate. Okay, for the last 10 years, it's been around 45%, okay, on average. It's a very high rate. Secondly, there is an unlimited supply of surplus labor. People can dispute it, but one of the things that is clear is the following. In 2012, the primary sector employs 33% of the Chinese labor force, but produces only about 10% of Chinese GDP. So that means there's still a lot of room for the movement of the labor force. Secondly, I think people worry about the labor shortage in China, but the working age population in China is defined with reference to Chinese retirement age, which is far too early. Women in China retire at 55. Men retire at 60. And in this day and age, there's no reason for that. And just as, a lengthening of that to 65 would create a substantial labor supply. The other thing is that, as some of you may know, is that the one-child policy is in the process of being ended, but that would not have an effect, for about 20 years. The other thing is a huge market, which allows economies of scale of all sorts, technological as well as market economies of scale. And we know that when you have a large market, R&D investments, as well as investment in goodwill branding, have huge returns, really huge returns. And that is actually one of the reasons why China's been growing quite well. Now, I want to introduce one concept here. If you look at China today, almost every sector has excess capacity. Steel, cement, glass, solar panels, aluminum, So in fact, output in China is not constrained by supply. It's really constrained by demand. As long as there's demand, there will be supply. And I think that's an important thing to realize about the looking forward of the Chinese GDP. So I think a hard landing is really very unlikely. Let me just show you this. This is quarterly rates of growth for Chinese real GDP. I have color-coded it because there's huge seasonalities in Chinese data. But if you compare the blue columns with blue columns, yellow columns with all yellow columns, you'll note that things have stabilized. Okay, and this is not only chart. You can look at this. This is real value added industrial sector. Again, you can see that it's come down quite a bit from 2-3 years ago, but it's now stabilized. And the GDP growth rate is around somewhere between 7 and 8%. This is monthly rate of fixed assets investment. And I'm sorry, let's see. Let me see if I could go back one. This is monthly growth rate of Chinese real retail sales. So you can see that actually it's come down, but it's really stabilized. So I think a hard landing is really not a likely scenario. People worry about local government debt. I think that is actually a problem that can be handled. We don't have time to go into it, but roughly speaking, if you add up central government debt as well as say half of the local government debt, which if you believe it will go up, the public debt to GDP ratio would be roughly speaking below 40%, which is really quite manageable considering that the US public debt to GDP ratio is 150%. In Japan, it's actually above 200%. So, and for many of the same reasons, this really can be quite manageable. Shadow banking is a problem. The estimate is that maybe 30% of Chinese financing today is of GDP is done through shadow banking, and it is a problem. The Chinese government is paying attention to it, so hopefully it will be able to manage this problem. So let me just conclude here. I think I'm an optimist. I think that the Chinese economy can continue growing at around 7% for basically as far as we can see. Thank you very much.
Thank you, Professor Lau. So next speaker is Professor Kiyotaki.
I'd like to speak about the financial frictions and economic growth, and especially in the context of recovery from the Great Recession in recent time. And during the financial crisis, we have lots of problems. One is the shortage of liquidity, funding, and also bank lost a lot of equity, and also macro economy is dropping sharply. And for this each problem, one of the textbook answer is try to assign the policy which is strongest. This is according to the Robert Mandel's policy assignment argument. So concerning liquidity shortage, the strongest policy is the lender of last resort or various measure of liquidity provisions. And against the shortage of bank capital, we should restructure the insolvent banks and also inject equity to the solvent banks. And macro stability, monetary fiscal policy are considered to be most effective. But during the crisis, actually, there is no easy way to distinguish between liquidity shortage and shortage of bank capital, because the bank capital depend upon the asset price, and the asset price depend upon liquidity, and the liquidity shortage you cannot just solve by pumping in money, because if bank don't have enough equity, their lending capacity is limited. So in this sense, a lot of things are interconnected. So it's not just the strongest policy, but other policy has to be simultaneously used. And if you look at the injecting capital, actually Japan took a long time to recognize loan loss. As a result, it took a long time to inject enough equity to the banking system. Only under the Koizumi government, 10 years later, after the crisis started, we cleaned up the banking sector seriously and recapitalized. And in this sense, actually, the Europe doing the somewhat similar mistakes. And after the crisis, actually the policy became much more easy, more closer to Mandel's policy assignment. Macro stability, the monetary policy are the main player. And the financial stability, the financial regulation, and also against the macroeconomic stability. Actually, recently more and more central bankers and regulator introduced the macro-prudential policy. Basically, during the booms, you try to tighten a little bit by acquiring more bank capital, and during the recession, relax the bank capital requirement. And concerning the social insurance or public goods supply, the fiscal policy are the main actors. And so the things become much simpler after the crisis. But when we look around the world, the recovery after the crisis depends upon a lot on the balance sheet conditions and the real rigidity, and also the trend growth of the economy. And typically, what we see is the output or working capital investment or stock price typically come back relatively quickly within the 2 or 3 years after the crisis, bottom of the crisis. But the one which doesn't recover so easily is a credit or fixed capital investment, and also real estate prices. These are the area which it's very involved in financial systems. Until financial system recovers, these things takes long time. And actually, when you look at the balance sheet of the non-financial business, the non-financial business has a asset sides, financial assets, working capital, and tangible and intangible capital. And Professor FUKAO said the non-financial business is now saving a lot. This show up in the financial assets. And part of the financial assets is actually the acquisition of the subsidiary companies, overseas subsidiary companies. So this is the method to invest in overseas, like FDI. And when the recession hit, the illiquid assets like fixed capital is not easy to decline. This is the problem of real rigidities. Like the capital or fixed capital has a certain irreversibilities, not easy to sell. So what happened is the liquid assets, like a working capital investment, is the one which cut. And if there is no financial frictions, actually the working capital and the fixed capital are complement input. So the economy dropped from point A to point B. Like it doesn't drop so much because of since the fixed capital is still very high, you should put the at least some amount of the liquid capital, like a working capital. But when the business is facing financing constraint, actually because you cannot cut the fixed capital, you have to cut the one which you can adjust. Part of them is adjusted by selling the financial assets, but partly adjusting the working capital. So working capital drops to the point like a B. So it's a bit like a overshooting. So, and over time, the fixed capital starts decumulating. So economy is going back to the little bit more balanced position, like C. So the initial adjustment is a bit like a overshooting. And that's why the working capital is a very volatile component. But after the recovery, the initial movement is the working capital is recovered from C to B. And initially, the company is very hesitant to increase the fixed capital because of it might come back again. So until you accumulate enough liquidities, the company tends to accumulate only liquid assets. This is also true for the employment. You can think of the illiquid assets as the permanent employment, while the liquid one is the temporary employment. So the recovery phase, typically permanent employment doesn't increase so easily. Initially, only the temporary employment increases. Only after the recovery is underway, the economy starts moving from D to A, the permanent employment is coming back. So that's why typically the recovery is the fast in output or working capital or stock price, while the recovery is slow in fixed capital investment and the real estate values. And I should say one of the long-run consequences of the financial crisis is the one which Professor FUKAO and talked about, is the public debt become unsustainable, which happened in Southern European countries. So then it can lead to the further financial crisis. But another dangerous thing, which is related to the KLEMS theme, is actually the business reduce the investment in intangible capital. The intangible capital accumulation is actually through the R&D investment, as well as the hiring the permanent worker and training them. So during the crisis, and especially when the company is short in cash, they cut the R&D investment, as well as they instead of firing the permanent worker, they stop hiring the younger workers. But when they stop hiring the younger workers, they stop training them. And as a result, they slow down the intangible capital accumulations. And one of the strengths of Japanese company is actually the hiring the younger people and train them on the job. And if you don't stop doing that, that leads to the slower growth. That's one of the way to explaining why country may enter into the long recessions after the financial crisis. And this very much depends upon the real rigidity, like how much you can adjust the fixed capital or permanent employment of the old-timers, and how much burden is going to the younger people. So that's my discussions.
Thank you. Okay, we'd like to move to the trade issues. So the fourth speaker is Professor Timmer, please.
Thank you, Mr. Chairman. I would like to talk a little bit about trade issues, basically picking up on the points which have been made very forcefully by Professor Fujita in his keynote lecture, where he basically showed this increasing interdependence between economies, which is manifested in increasing flows of intermediate inputs, increasing interconnection of investment flows, finance flows, goods and services flows. Because basically, if you take that seriously, this new reality of the global economy, that means that our view on competitiveness also needs to shift. And the only point which I would like to make in the upcoming 9 minutes is that we basically need a new view on trade and a new view on competitiveness. So what's the old view? The old view on competitiveness is based on products. Typically, when you look at rankings of countries in competitiveness, one of the first indicators is gross exports. So the value of exports from a country, and that is seen as an indicator of the competitive strength of an economy. But nowadays we know that when there is international production fragmentation and different activities take place in different countries, this look on a gross export as an indicator of competitiveness is losing its value rather rapidly. So to give you an example, I'm from the Netherlands. We are exporting a lot of flowers, tulips. These are being characterized as low-tech goods, but basically what the Netherlands does in tulips is a lot of R&D and branding, which are very high value-added activities. On the other hand, you have China exporting an iPod or an iPad, and we all know that the value which is added in China itself is very low. So this example already shows to you that if you compare export values, you can get a misleading idea about what is competitive, the competitive strengths of nations. So what do we need to do? Well, basically what we need to do is not to look at the value, the gross output value of products anymore, but we should look at the value added, which is taking place in various regions in the world. So if you take the example of a car being produced in Japan, picking up the example of Professor Fujita, there is a lot of different elements in this car which are not originating in Japan. And vice versa, a Japan produced in China consists of a lot of elements which are non-Chinese. So basically it's not longer about what you sell or what you export, but it is about what activities you do in the global production of a good or a service. Now, in the international business literature, this is already well known. If you talk to business people, they tend to think in terms of value added rather than in terms of gross output. This is a well-known curve from the international business and management literature, which is called the smile curve, which basically indicates the different activities which countries or companies can perform in the production of a good or a service. So we have the so-called pre-production activities, which include R&D, designing, purchasing of intermediates. We have the actual production activities. We have the post-production activities, distribution, marketing, after-sales services. And the idea here is that actually countries and firms can specialize in different activities along this value chain. Especially the pre-production and the post-production phases seem to be having higher value-added content than the production activities, and there are some people who claim that this smile is so-called deepening, meaning that more and more of the profits and more of the value-added in production is actually in the post and the pre-production phases rather than in the manufacturing phase itself. So taking that to the issue of competitiveness, this basically means we need to figure out what activities do countries perform in these value chains. Well, one way to do that is, first of all, we need a conceptual framework actually to analyze this value-added perspective, and we need the data. Now, what is the conceptual framework? The conceptual framework harks back to an old literature in the input-output economics, where you basically try to trace all the different stages of production which are needed to produce a certain product. So you're going to decompose a so-called final product, a product which is ultimately consumed, into the different production stages and the activities in different countries. So here's an example where you have 3 countries involved in the production of a good. And basically what you can do now is you can decompose the output value of the product into the value which is added in the country itself and the value added which comes from another country. So take the example of a Japanese car. It has domestic value added content. This is the value added by capital and labor in the Japanese economy, but it also has a lot of content from Germany, from the US, from China, from the Philippines, etc., which flows into Japan through the imports of intermediates. So this is the conceptual framework which we can use. Then we need data to populate this conceptual framework, which until very recently was very hard to do, because you need 2 types of data. One is so-called inter-country input-output tables. These are input-output tables which tells you the flows of goods and services within an economy, but also across economies. Now recently there has been an increase in the availability of this type of data. There's a very long tradition here in Japan at IDE JETRO, where they have been developing these regional or multi-regional input-output tables. Secondly, you need KLEMS data, and this harks back to the talk by Professor Jorgensen. You need to have data on the intermediate inputs which are being used, both domestically produced and imported, and you need data on the production factors which are needed in production. So you need to know what type of labor, what type of capital is used in particular activities in these value chains. So we have the data, thanks to the World KLEMS initiative. This data is now available, and combined with the input-output tables, this actually allows you to analyze competitiveness in a completely new way. Now, if we do that, I'll give you 2 examples of trends in the global economy based on this new measure. One is a measure of international production fragmentation. And this graph basically tells you the amount of foreign value added in a particular global value chain. You're looking here at 560 global value chains of manufacturing products which are produced anywhere in the world. On the horizontal axis, you see the foreign value added share in 1995, and on the vertical axis in 2008. And you can see that in most of the global value chains, the share of value added coming from outside the economy is rapidly increasing. It's very high for the yellow dots. This is refined oil products, because not many countries actually have a domestic oil mining. It can be much lower, for example, for food, because most of the food actually is produced domestically and has strong backward linkages into the agricultural industry. And you see in green, you see the electronics. This is one of the most famous, say, fragmented production processes. In green, you indeed see that they have very high foreign value added rates. So fragmentation is increasing, but at the same time, you can see that this fragmentation process can still be extended, because the value added shares, the foreign value added shares, basically are on average 0.3, 0.4 at max, which means that still 60% of the value added is domestically added. And in principle, these activities can be fragmented as well. So although we see increasing fragmentation, we have not seen the end yet. Second point, if you look at this fragmentation process, it's natural to ask the following: is what is taking place, is it regionalization, so this clustering of activities within regions, regional blocks, or is it true global fragmentation? Now, if you look at gross export flows, so if you have the old view, you might think that there is increasing regionalization, because we see increasing flows of intermediate inputs between China, Japan and Korea, say the East Asian bloc. Within Europe, there's increasing trade in intermediate products, and also within NAFTA. But if you take the value-added view, things change, because in the value-added view, there is a lot of back and forth trade in intermediate goods, but the value added actually associated with that is very low. So if you redo that type of analysis based on a value added basis, what we see here is that we split up this trade and value added into regional value added. This is the RFVA, and the global foreign value added, the red line. And you see that this red line is increasing much faster than the blue line, basically indicating that global value chains have become truly global in the past 14 years. This trend has continued. It has continued over the crisis, as you can see. There was a dip in 2009, 2010 and 11, but it has been picking up and trend towards globalization rather than regionalization. Okay, so what are the implications of this? If you think through this new perspective of trade, this has an impact on the way we think about trade policies, think about social policies, industrial policies, and also has implications for our statistical systems because we need these new measures of competitiveness. Thank you.
Thank you.
Okay, so last speaker is Professor Van Ark. So I would like to ask him to summarize the our discussions and project the growth in the world economy, please.
Thank you very much. Yesterday morning I had the honor to be the first speaker at the conference. Now I have, and I'm not sure if it's an honor to be the last one and to keep you all awake, which for all of us has been already a long day, and there's more interesting things to come, I'm sure. So I'll try to be short and take you through, what are some of the important strategies that we need to look at in going forward. So the diagnosis you can essentially summarize in 10 major trends, 5 of which are short-term and 5 of which are medium to long-term. The short-term trends very quickly are that we do see currently a recovery taking place from the 2008-9 global and financial crisis in the mature economies. Very much driven by the United States. There we see some of the strongest recoveries taking place. Not so strong in the case of Europe, where we have some recovery, but it is a slow recovery compared to the depth of the recession. And also not so strong in Japan. Now, some of you may be surprised about that, and Kyoji FUKAO already earlier mentioned the fact that you're all celebrating at the moment that you just had a quarter of almost 6% growth on an annualized basis. But as Professor FUKAO mentioned, that is basically because your consumers went out on a shopping spree to be ahead of the value-added tax increases. And as a result, the second quarter is not going to look as great, and overall the projection for the Japanese economy remained fairly moderate for the next 2 years to come. The biggest events, however, are taking place in the emerging markets, where we see significant slowing down, which already started last year, partly because of the start of the retraction of quantitative easing in the United States, but more importantly, the emerging of more structural problems in many of the emerging economies. There is elevated financial risk in China. Professor Lau already spoke a little bit to this point. I do not quite agree with Professor Lau that the stability of GDP growth rates should make us feel confident. It actually doesn't make me feel confident at all. Our members at the conference board in China feel a lot more volatility than the GDP numbers suggest. And secondly, our colleague Harry Wu, who I think is somewhere in the audience here, has actually revised some of the Chinese numbers, showing that in reality there's a lot more volatility than the official number shows. However, I do agree with him that the chance of financial collapse and hard landing is relatively limited. However, what it does, it creates a lot of lack of confidence and weak confidence among consumers and investors in going forward. So I think even China is going to bring more volatility in the global economy. And then lastly, we see a lot of political issues. Now, political issues are always there, but probably 2014 is going to be a year with a lot of political tension. Some of it taking place in the rim of sort of Russia, Western Asia, and Middle East. But I should not forget to mention also the political issues that we're dealing with in this part of the world, including the issues between China and Vietnam and Japan and South Korea and so forth. So how these short-term trends are translating themselves in a global outlook, when we started off this year, we were hoping that the global economy would be able to grow at around 3.5%, but we had to adjust it a little bit downward because various countries now turn out to grow somewhat more slowly, particularly in the emerging markets. The only little plus here is the Indian economy, which has been confirmed just by the elections we had of a new president, and which creates a lot of confidence that economic reforms and economic growth may recover in India fairly soon. Now, going back, and oh yeah, here it is. Let's go to the medium and long-term trends. So let me show you the medium and long-term trends first, because this is the same chart as I just showed you, but now we're looking at growth rates for the next 5 and the next 10 years out. So the green bars are looking at the 2014 to 19, and the blue bars to the 20 to 25 growth rates. And what we're seeing here is that over the next 10 years, the base scenario that we're looking at is actually looking at a significant slowdown in the global economy. And a lot of that slowdown in the global economy is driven by the emerging markets. Note they're still growing much faster than the emerging markets. We continue to see the shift towards emerging economies in the global economy, but it is going to be a much more slower process than what we have seen before. Now, what are the trends causing that? Well, first of all, demographics. Demographics in the mature economies, which has been very extensively discussed already earlier, driven by Japan, but also other emerging markets, mature markets, particularly in Europe, is going to be a major factor of slower growth in the mature economies. But even some of the larger emerging markets are beginning to see the first signs of slowing demographics. China already clearly is there, as Professor Lau has referred to earlier. Brazil and India and Mexico have still a much longer way to go, but in the next decade we'll begin to see some changes there as well. The next important element is that the global demand shifts that are taking place towards rising middle classes in the global economy are definitely going to continue. That is going to be very important. We will see, even in these slower growing emerging markets, more people coming out of poverty and being added to the middle class. But again, that shift is going to be much slower than we are used to. However, the emerging middle class will become richer itself and will begin to ask for a lot of new products and services, and that's a really positive sign of things that are going on. But the most important aspect of this slowing growth in the emerging markets is the fact that the emerging markets are simply becoming richer. And that's just a natural thing. If you become richer, you're going to begin to grow more slowly, because your economy is going to be much more driven by services, it's going to be much more driven by the consumer rather than by investment and exports and all these kind of things. And as a result, the economy is going to slower. That is what we have seen in the United States, in Europe, in Japan. That's what we're going to see in emerging economies that already have fully emerged. That doesn't mean that there are no emerging economies that would not be able to grow significantly faster. Indonesia, Turkey, South Africa, I mean, there are many other economies that could do this, but all these economies are so much smaller than the 3 or 4 big ones that we're currently looking at, China, India, Brazil, and Mexico, that they will not make up for the slowing growth that we're seeing in that part of the world. And then finally, a medium to long-term trend is the slowdown in the trend of globalization. And again, there's already been some discussion here on this aspect, the fact that trade agreements are really coming through very, very slowly, and to the extent that they are coming through, they seem to be relatively narrow, regionalized, sometimes even bilateral. That's more than nothing, but ultimately, as we know from history, the global economy is benefiting most from multilateral trade agreements. We have major environmental challenges which will require international coordination, and will have major imbalances ongoing in the energy markets in terms of increased demand for emerging markets, supply from the United States, and major changes that are going to take place in the Middle East, for example, in going forward. Now, with all those major trends, let me go through a lot of slides because I want to stay on my time, and basically talk about what are the important implications of that for economic policy. Well, I think that can be divided, and this goes back to our KLEMS meeting that we have had in the past couple of days, in 2 major groups. We need an investment agenda and we need a productivity agenda. And both of them are very, very closely related. The investment agenda, and I reflect some of the ideas and thoughts that have been in this meeting this afternoon, but also in the past 1.5 days. A lot of the investment is not anymore in the hard buildings and machinery, and we need some of that. We need more hard infrastructure, certainly in many of the emerging markets. but a lot of the investment is going to take place in the intangibles part of the economy. The investment in human capital, in people, the investment in innovative property, R&D and non-R&D, and the overall investment in what we would call economic competencies, the ability to drive marketing and branding, to change organizations, and so on and so forth. We need a very balanced path of investment. The private sector needs to take the lead, but the public sector needs to help to pave the way for private sector investment to be successful, and partnerships are quite often a useful element to that, and again, something difficult to achieve. We need to avoid that fiscal consolidation, as it is happening in many of today's mature markets that are suffering from major sovereign debt problems, that the fiscal consolidation is going to give all the priority to the reforms in social entitlements, so that we're not able to make the growth-promoting investments in the economy anymore. And we need to find ways for new firms, for innovative firms, and for entrepreneurships, and we need to make sure that we have the money to finance them. The productivity focused reform agenda is going to focus on the market reforms in product markets, in labor markets, and capital markets. And let's just remind ourselves what these reforms are for. These reforms are there in order to make sure that the most productive resources in our economy go to those areas where we can have the highest returns. So we need to make sure that every time our resources are not going to be stuck in those parts of the economy where we do not get the returns. For that, we need to accelerate global, regional, and economic integration. And we need to really try to get over the issues of what we sometimes call vested interests that are there in the economy, to increase transparency in order to drive the economy forward. And that is exactly bringing me at a point of zero. And I hope this will open us up for discussion. Thank you.
Thank you for all panelists. So we'd like to move to to discussion. So,
allow me to speak in Japanese. Well, so far, I have closely listened to your presentations. And roughly speaking, first, there is this issue of finance, a trade issue. And I said that I wanted to focus on these two, but in the financial matters, in particular, through finance, what kinds of investment should be promoted? On this issue, Professor FUKAO and Professor KIYOTAKI and Professor Van Ark, I think you all mentioned these things in your presentations. So on this matter, in the financial policies changes, especially in the United States, there were changes in the financial policies. What kinds of investment should be promoted? I understand that the situation differs from country to country, but what types of investment should be promoted? What would be the desirable picture along the recent financial policies? Perhaps Professor KIYOTAKI, you could start.
So during the crisis, we are doing a lot of new initiatives, like unorthodox or unconventional monetary policy. Basically, work on the spread. So interest rate is already hitting zero. So the place to work on is the spread between the high risk returns or illiquid assets to the liquid assets. And after the crisis is coming down, the government is working on the term spread, like difference in the long-term interest rate and the short-term interest rate. This is the philosophy of quantitative easing, basically trying to reduce the spread between long and short. And this has some advantage, but they also some side effect. Side effect could be showing up in the other countries. But at the same time, the U.S. point of view, probably Fed people said that we are responsible for U.S. economy, not the other country. And as long as the flexible exchange rate is pursued, the other country can look after themselves. So the monetary policy is not almighty. Just work on these various spreads, and side effect, other country has to look after themselves. That's the kind of the philosophy they have.
Thank you. Okay. それでは深尾さんの方も
Professor FUKAO, Professor Kiyotaki, both of you spoke about the monetary policies at the United States. The Fed has changed the FRB tapering policy. According to what the US decides, there might be some impact. They will have to think about their own economies on their own. Japan would also be impacted. In a sense, Japan has its own monetary policy, as Professor FUKAO mentioned. Whether this is successful to promote the growth of real economy, otherwise it would be problematic. And one point is the return of the investment. If you could elaborate a bit more on that point. Other members have already emphasized this point, but in the case of Japan, investment into tangible properties was still high. Despite the drop in population and despite the productivity, there has been high investment in the tangible. There was zero interest rate policy, and loan provision by the banks has been supported. Collateral has been provided or loan has been guaranteed to support. But the SMEs, the investment into intangibles, investment into ICT, and SME has not invested much in R&D. And therefore, investment into assets other than tangibles, that is the area that has to be emphasized further. In particular, the SMEs will have to invest more into intangibles. International monetary system in this globalized world, the advanced economies' growth is decelerating, but there are many investment opportunities in the other countries, and therefore how to re-establish international monetary system is another key point.
So, Professor Kiyotaki and Professor FUKAO also emphasized the role of intangible investment on the economic growth. And so in the World KLEMS conference, the same discussion was conducted. So, but today, so the Professor Kiyotaki argues that so intangible investment is liquidity constrained. So we have new types of financial policies to promote intangible investment. Professor Van Ark also emphasized intangible investment. So how do you think about the policy for promoting the intangible investment from the financial side? So you can pick up the examples in the European countries or other countries.
Well, I would actually like to pick up the example for the United States, because that's where we see some of the new evidence emerging. Professor Jorgensen already earlier referred to the fact that there are significant debates about reforms in financial market policies in the United States, focused, for example, on the reforms in the housing market. But where we still see a lot of weakness is in terms of financing small, new, innovative enterprises. Very interestingly, what we're seeing at the moment is that in the aftermath of the financial crisis, we actually see a very slow emergence of new firms in the United States, which is very unusual because the US is, of course, a country and economy with a lot of new firms. But since the recession, there has been, as far as the new micro-evidence is now suggesting, a very slow start of new firms. And one of the reasons for this is probably the lack of funding for these new firms. It are those new firms which are quite often the ones which are most innovative, that really start off with investing in new ideas, new designs, all the kind of intangibles that we were talking about. And there are, of course, risky investments. And that is why many banks have resisted to make funding available for those new startup firms, as was the case in the past. So we're all kind of overtaken by the great news that we hear about all the activities around Silicon Valley and so on, but that is a small part of the story. The economy is really driven by a much wider range of innovative firms across the economy, and I think the US evidence is showing us that that is one of the areas of major concern. Now, if that's a concern in the United States, I guarantee you that it is a concern in the rest of the mature economies as well. So I think that's the area where we need to see new and original innovation in the financing world to fund these new firms with capital.
So, Professor Landau wants to discuss this issue.
Thank you. I actually like to add an observation on the innovation in East Asia. We all agree that innovation is important. Mr. Fujita talked about it, and it is really a major driving force for technical progress or for increase in total effective productivity. But in my observation, that in East Asia, it's particularly difficult to really have productive innovation for two reasons. One is that there's too high a level of respect for authority. Okay, you know that people really don't challenge established authority very easily. I mean, this is true for China, true for Korea, Taiwan, perhaps even Japan. And that's really one reason why you don't really find breakthrough innovations being adopted in these East Asian countries. You know, we simply respect the silver. We respect it too much, right? So there's no challenge. And it's not true for the United States, you know, that people challenge authorities all the time. But the other problem is that also in East Asia, there's very low tolerance for failure. You know, that is, if you fail, you know, let's say you try to raise capital, it's very difficult to raise capital for a venture in East Asia. But if you fail, that's the end. You know, you don't get a second chance. Now, in Silicon Valley, I know many entrepreneurs who succeed on the third try. They lose money the first time, you know, and the second time, people would continue to fund them. They say they probably learned something from the first time. And they fail the second time, they would go raise money again. And the third time, they do it. But I think in East Asia, not just in Japan, overall, that there's too high a respect for authority, for you know, and too low a tolerance for failure. And I think we need to overcome that. That's a cultural disadvantage. Yeah, thank you.
Do you have any comments on this issue?
On the cultural one?
Well, maybe so you are. You also emphasize the role of marketing and services in new types of trade. So maybe so. If you have some comments on that.
Well, perhaps I can add a little bit of European flavor, as, because Bart has become a US citizen almost, so I'm the only European here. So in Europe, there's a real concern, indeed, that loans are not flowing to the small businesses, and that the European Central Bank has requested a major survey within Europe, trying to find out whether that is actually true. And the results indicated that indeed that these small businesses are really liquidity constrained. Now you might say these small businesses do not have much opportunity, so perhaps that's not really the issue, but it seems that also profitable investments are not getting the finance they need. So definitely it's an issue which also haunts Europe. Yeah.
Thank you. Okay, so we'd like to move to the China issue. So, you know, from the perspective of my Professor Van Ark, so the future growth in China is so seems to me so pessimistic. So, but Professor Lau shows the optimistic view. So, do you have any comments on Professor Van Ark's view?
Actually, I don't think he's that pessimistic. If you look at his chart, if I read it correctly, his optimistic projection is a little bit above 7%, right? And his pessimistic one is much lower, but I think it's actually around 4 or something like that. So it's not actually so bad. I mean, I think that's all right. But I do want to add one thing, and that is he talked about volatility in Chinese growth rates. And I think we need to think about what are the possible sources of the volatility. Okay, I show you a chart, basically showing that the Chinese economy is pretty much immune to whatever happens outside. I mean, there's some effect, but it's not a huge effect. And I think going forward, if you really think about it, what would be the sources of aggregate demand in China? Okay, I think it's too early to talk about consumption because household income in China is less than 50% of GDP. I mean, people will tell you that the consumption would drive Chinese growth is just, it's just 20 years too early. Okay, it's not going to happen. Chinese growth in the next 5-10 years will be very much based on investment. Okay, especially public infrastructure investment and on public consumption, meaning education, healthcare, environmental control, environmental preservation and restoration. Those will all be public consumption, okay? And these things are going to be directed by the government, okay? I mean, you want to clean up the river, clean up the air. No private firm, private individual can do it. This really demand is public demand. Education, healthcare, I think we're all really looking at very much a public sector involvement. So I actually don't think there is really that much volatility. In fact, what you would see is that the government will stand by. And if it looks like aggregate demand is insufficient, there would be some effort to put in a mini stimulus, in any one of these areas. So I'm reasonably optimistic that that 7% is actually achievable.
So first of all, we should realize, and that's often forgotten, that the Chinese economy has already very significantly slowed down, if we believe the official numbers. So, a few years ago, the Chinese economy was growing on average by more than 10%. At that time, we were told by the Chinese government that it was totally unacceptable. The social growth rate couldn't be higher than 8%. And then gradually, of course, the economy started to slow down, mainly because investment started to slow down. And now they're saying that 7% is really the absolute minimum, and they will have to go further down because this economy is just gradually beginning to, it's a difficult process, I agree, but gradually beginning to transform from an investment, export, low-cost driven economy to an economy with higher wages, with more consumer power, with more purchasing power, and ultimately more consumption. And therefore, the Chinese government will come out, I guarantee you, in a year or two and say it's 6% that's the social acceptable rate, and in 4 years they'll say it is 5%. And that's a perfectly normal process. They're just preparing the population for the fact that the economy is more slowly to grow. Now, it's true that the slowdown is largely driven by slower investment. There is not much of an increase in consumption. I agree with Professor Lau that increase in consumption is actually really difficult to achieve. But there is something going on with investment. At an aggregate level, it looks like a very smooth number. But if you go and look deeply where the investment is taking place, it is extraordinarily volatile. The Chinese government is extremely confusing about its strategic policies. It's opening up the door for foreign direct investment and it is closing it again. It is giving priorities to state-owned enterprises, then suddenly says that private enterprises can come in. Multinational enterprises are very confused on how to operate in this transitional process. The China's transition is an extremely difficult process, and multinational businesses basically feel it's one of the most difficult business environments to operate in, even though growth is still very fast. So I just don't share the view of the smoothness. There's nothing smooth about it. It's a very volatile adjustment process. That's not a hard landing, but it is something that we need to prepare ourselves for.
Okay. So In the short run, I want to agree with Professor Bernard because I'm afraid that not only firms but also household will be liquidity constrained maybe. So due to the bad loans. But I'd like to ask Professor Kiyotaki about the non-performing loans in I
don't know much about non-performing loan in China because I don't follow so closely, but the number shadow banking system looks getting big, and sometimes the accounting system is like a little bit difficult to follow. And sometimes company has a public face as well as private face, and they can smoothly shift between two in terms of accounting. So I cannot tell so easily what's going on in non-performing loan. One thing you can say is as the economy slows down, real estate value. Real estate value is a capitalized value of future rent, and if the rent growth rate is slowing down, the price rental ratio has to go down. So at this point, probably some of the non-performing loan build up in the real estate sectors. And in terms of actually the one I worry is also the Europe's non-performing loan, especially Southern Europe. There seems to be a lot of hiding going on. And because of the non-reporting of the banks are slow in recognizing loan loss. They are very slow in recapitalizing, which seems to dragging the growth in Southern European countries too.
Yes, so I'd like to ask Professor FUKAO. So the effect of volatility in the Chinese economy on Japanese economy. So
No,
so you know.
So the question on non-performing loans in China is not whether there are non-performing loans or not. They're massive and they're very rapidly increasing. The question is whether the Chinese government is willing to bail them out. And so far, so good. They will continue to bail them out. And sometimes they drop a little note and say, we're not going to bail something out. And as soon as that happens, and we've seen a few examples of that in the past year, we'll see a few more because they're testing the waters. But as soon as we see it, there's a lot of nervousness in the market. So again, it's a sign of the huge amount of volatility. As soon as the Chinese government or the People's Bank of China gives a little bit of an indication that they may not be willing to bail out these massive amounts of non-performing loans, there's a lot of nervousness in the market. So, we just keep doing this for a while, and maybe that's the best way to gradually adjust this slowing growth rate of the economy. And we'll just hope that we'll be able to do this, and we'll gradually go down to the 5 or 4% normal growth rate that the Chinese economy would need to have in the longer term.
I think this is all nonsense. I think all nonsense. I already explained the non-performing loan. The maximum, if you even consider all the local government loans to be non-performing, you add them in, we have really a public debt to GDP ratio that's less than 40%. Okay, that's including everything. All right. Now, but I want to say that the other thing that's really makes very little sense is this so-called social minimum rate of growth. That really makes no sense either. I mean, the important thing the Chinese government focuses on is unemployment, not on GDP growth. It's really not on GDP growth. I mean, people would tell you, the journalists, for years have claimed that China needs to grow at 8%. Right? Otherwise there would be chaos. But 8% growth 10 years ago is really equivalent to 4% growth today in real terms. So it's really complete nonsense. The other thing that's happening is that Chinese economy has shifted from mostly based on manufacturing to service sector. Service sector is now bigger than the manufacturing sector. And service sector actually generates more employment per unit GDP than the manufacturing sector. So I really don't share Van Bach's pessimism But I think Chinese economy will survive 6%, even occasionally 5%. But I think if you really look at the fundamentals, with a savings rate of 45%, you invest, your public investment, it's just hard to see a 4%, 5% scenario. Okay, maybe 20 years from now, perhaps, but not in the short term, intermediate term.
So although the Chinese economy is very important for the not only Japan but also the global economy, but so we'd like to move to another issue, so the trade issue. So due to the limited time, so the Professor Timar skipped several policies on the trade issues. So, for example, he wrote a couple of issues on the concerning the new types of trade. So, could you explain the policies corresponding to the structural change in the global trade? So you mentioned the trade policies, social policies, industrial policies in your presentation paper.
I think one of the outcomes when you take this new view on trade is that industrial policies, meaning policies which are geared to particular sectors in the economy, are not very effective. There's a big discussion within Europe and also within the Netherlands of stimulating particular industries, and manufacturing is highlighted always. But it's not necessarily that manufacturing is something special. Some activities within manufacturing are very important and have spillover effects. But there are also many spillover effects in service activities. So industrial policies geared towards industries rather than, say, products or value chains, I think, are not very effective anymore. With regard to trade policies, because of these increasing value chains, you see a lot of interdependencies between countries and between regions, which means that any trade barrier escalates. So this is a standard result that tariffs might seem low, but if there's a lot of back and forth trade going on, actually that the tariffs are accumulating, and in the end they can be pretty high. So definitely declining tariffs through the trade agreements is something which should be high on the agenda. Trade and services is very important. Within Europe, for example, there is a free market for goods, but there's still a lot of prohibitions in trade and services. Now, looking forward, the interesting question is, to what extent will this fragmentation continue? Because, of course, it's not obvious that this globalization will go on. So one major trend, which also indicated by in the keynote of Professor Fujita, is the decline in transportation and in communication cost. Most likely this will continue also in the upcoming years, but there are other elements which also determine, I think, fragmentation. One of them is vulnerability. So to what extent indeed are multinational firms concerned about these increasing vulnerabilities? Cheap labor is another one. So is China running out of cheap labor? Yes or no? This is a discussion. But will there be other, say, pockets of cheap labor in the world economy? If so, fragmentation will continue. If not, fragmentation might reverse. And we've seen the increasing riots in Vietnam, for example, where there's a lot of cheap labor which is being taken advantage of, but that might have a backslash. The other thing is reshoring, which is an issue, especially in the US, the idea that manufacturing activities which have been offshored can return to the US. And one of the main reasons which might lead to this is the cheap energy. And the hope is that manufacturing might come back because of this new comparative advantage of the US economy. I think that's a little bit misleading. There might be reshoring taking place for the US or for Europe, but that will not be very labor-intensive production. Most likely, these production activities which come back will be highly capital-intensive, which has consequences then for the employment perspective, especially for low-skilled labor. And that's the reason why I think trade policies should go together with social policies there needs to be reskilling, re-education of workers, and there should be some kind of safety net in order to have this process of creative destruction taking place for everyone.
So thank you so much. So the structure change in trade, so as Professor Tima argued, so may affect the current trade balance deficit in Japan. So many economists and many Japanese economists expected that depreciation of yen induced by Abenomics will sorry, so the induced leads to the trade balance surplus. So, but these expectations are failed. I think so. So, could you? I'd like to ask Professor FUKAO so about this issue.
Yeah, as Professor Miyagawa pointed out, from the viewpoint of real effective exchange rate, yen is very cheap already. So almost, I would say, cheapest from almost the same level as the beginning of 1980s. And yeah, yen-dollar exchange rate is still 100 yen. It looks expensive, but our price declined a lot. And so from the viewpoint of real exchange rate, very cheap. But our trade, we have a trade deficit, and current account surplus is almost zero, I think, or something like that. And of course, we have temporary factors like our nuclear power plants are all shut down, and we need to import a lot of natural gas, and also slowdown of Chinese economy. Probably we cannot export a lot of investment goods, for example. But also our low productivity growth in the manufacturing sector, for example, the electrical machinery sector, and also that through our FDI and expansion of production in other Asian countries, global value chain changed. And Japan is losing our competitiveness. And to analyze these issues, the data presented today, that is the KLEMS type data and global value chain data are ideal to analyze. And I know some scholars, like scholars at IDE, Ajiken, Inomata-san and others are doing, analyzing this issue, but still we can do a lot of that kind of analysis. And I think, yeah, we need the cheap yen means our, purchasing power of our wage declines. So I think it's a serious problem.
So, Professor Baumark, have a comment?
Yeah, I just want to make sure that I'm not going to down after this seminar as the pessimist on the global economy. So I wanted to say something positive, and that is that I think there's a very encouraging sign that in the trade agreements, even though they are perhaps involving too few countries, that certainly the TPP actually does recognize the importance of global value chain. So the traditional trade agreements, which were very much about things that were happening at the border, you now see that the TPP is really deeply looking into things like government procurement and labor laws and things around intellectual property and so on and so forth. And I think that's all very important in order to recognize this global value chain concept that Marcel has been describing. The main question, and that's a question I have to some of the people of the panel, of course, is can the TPP be ever successful if China is not going to be part of it?
Thank you. So
I wonder if there's an answer.
Sorry. Okay, so we'd like to summarize our discussion. So maybe everyone agree with the important role of innovation and productivity growth for the future sustainable growth. So the problem is policies for enhancing innovation and productivity growth. So I'd like to ask everyone to mention about the innovation enhancing policies. So for your country which you are interested in, of course for the global economy, so it's okay. For China, for Japan, it's okay. So first one, the first is Professor FUKAO.
Thank you. As in the case of Japan, as we already discussed, the intangible investment and ICT investment by especially small and medium-sized firms, and also the startup of firms rate is, I think, even lower than US, present US, very low in Japan. And also, we don't have good statistics to measure the startup of firms. At OECD, now the scholars are studying using business register data to study about startup of new firms. But in the case of Japan, we have just 1 year new, business register we only have. So we cannot make panel data yet. So also we need to, change our statistical system. And also, of course, the labor market rigidity problem and also hollowing out problem. Now Japanese automobile, I'll skip this. And, and also I would like to point out this policy making process. As Professor Dale Jorgensen pointed out, I think we don't have policy making based on empirical, reliable data yet. And also after the policy result is come out, nobody takes, responsibility. And also our bureaucracy is so, respected, as you pointed out. And there is no exact counterpart to the bureaucracy. And so we don't have a Brookings type, research institute. So probably RIETI is something like that. But
you have a last comment to innovation policy?
Okay, thank you. As I actually already mentioned, I mean, it's a cultural thing that takes a long time to change. But I think one can do a lot in the short term by maybe, giving R&D expenditure credit and somehow facilitating small startup enterprises and, giving them low rent, whatever, just getting them started. I think that might be useful. But I actually like to take this opportunity to return to something that Mr. Fujita said, and that is, I think if you really want to expand trade, let's say within East Asia, to a greater extent, I think one should take a take a page from the Eurozone. If you really look at trade in the Eurozone, after it has adopted the euro, let's say in 1999, trade, intra-Eurozone trade, actually tripled in the 10 years afterwards. Tripled. And that is really to tell you that stability of relative exchange rates is actually very important. That is, the Eurozone had no tariffs, on goods, for 40 years before, since the common market. But trade actually could triple, after this. So the point I'm trying to make is that if one could somehow, in East Asia, maintain a system of relative parities, not absolute parity, relative parities among the currency rates, I think it could really promote intra-East Asian trade to a large extent. And why are we where we are? We are where we are because the United States unilaterally, abolished the Bretton Woods Agreement, okay, which means that we have all these speculations on currencies, around the world. If we don't have that volatility, I think trade and cross-border investment would actually increase quite rapidly. And I'll just give you one number and then I'll stop. Every day, foreign exchange trading transactions every day is about $5.3 trillion. Okay, total annual trade worldwide is about $20 trillion per year. All right, and this is 5.3 trillion per day. You have to ask, do we really need that, such a high volume of foreign currency trading to support our international transactions? Thank you.
Thank you. So, please. So maybe each discussion has 2 minutes.
Okay.
So we'd like to open the
So concerning the policy for growth, R&D, promoting R&D is one of them, but also the promoting the human capital accumulation on the job is another important thing. I guess. The last 20 years, the Japanese economy is in recession, and the many companies are slowing hiring the younger people in the permanent basis, and that tends to slow down a lot of on-the-job training. And younger people and older people are short run kind of doing the similar things like a substitute. But in the long run, actually, they are complement because of the old-timer skill is transferred to the youngsters, and the old-timer get the encouragement from the younger people. So when the people become short in cash, and also they become more nearsighted, actually the companies hesitate to hire the younger people in the permanent basis. So I think this is also happening, unfortunately, some of the European countries, like Italy and Spain especially. So I would say try to reduce the restriction on old-timer and also promoting to hire youngsters is actually one of the important elements for promoting growth.
So when you talk about innovation policies, there's 3 levels of policy to think about: international, national, and regional and local. And I think we need to really think hard about the various roles. So international, the first role is open global markets. And it is things like, the trade agreements that we were talking about earlier that recognize the complexity of today's global value chain and trade system. And I think that's, for example, Europe has a lot to gain there in terms of creating that European-wide, but it's also certainly true for the TPP as well as for the transatlantic agreement. At a national level, I very much agree with Professor Jorgensen. Don't burn your fingers on innovation policy at a national level. It's just not going to work. Focus on product markets, on labor markets, on capital markets, on good tech policy, in order to make sure that the resources in the economy can be used most productively. Most of the excitement towards real innovation policies are taking place at regional or even local level, because that's where government and business and education systems are working together, try things out, create platforms where they can meet, where they can exchange ideas, and where they can work together. And the reason why in the United States, and in Europe, by the way, and probably also in Asia, you have some of these locations that are so much more innovative than others, is because government and business and education systems have managed to work together very well. So that's where innovation policy is most successful in the pure term of the word.
Thank you. We have 15 minutes or so. This is the chance for you to ask questions from the floor.
I have a question for Professor Lau. There's an offense from the U.S. government for Chinese yuan's appreciation in around 2003 or so when I attended the symposium in Chicago. And you show the patent growth diagram and patent granted to the U.S. diagram. How will it be increasing? I mean, China's market is very big, and China has become the world factory. So their patent was basically granted to the China rather than overseas countries. But it's increasing these days. What will be your forecast for the patent growth, granted growth to the US? That's my question to you. Will it be like Japan or not? Or will it be more modest? And I also have a question for Professor Timmer. You showed us the new view is on the activities in global value chains from R&D to services. Would you elaborate on how that pattern differs from, say, Toyota, Honda, and Nissan Renault companies to Volkswagen or Mercedes-Benz or a Dutch motor company? Would you elaborate on it? Their emphasis may be a little different from one company to another. That's my question to you. And I have a question for Bart Ark. You said that the globalization of emerging countries may slow down. But our negotiation, especially between US and Japan, might influence globalization of emerging economies. You might elaborate on that issue a little more. And I have a question for Professor FUKAO about Japanese yen's appreciation or depreciation toward the Olympic year 2020 in 6 years.
Two brief questions. I thought that there was a remarkable lack of discussion about social and income inequality in relation to growth and the crisis. And admittedly, there was some mention about sustainable development in terms of the environment, but I would welcome the panelists to comment further on that. And the second point is with regard to innovation policy and trade, the devil is often in the detail. And what surprises me a little bit is that there's precious little discussion so far about issues about competition policy, incentive mechanisms, corporate and national governance structures, and how those are interrelated with innovation. And then in the area of trade, most of the action is with non-tariff barriers. And again, very little discussion about that. So those are my questions. Thank you.
So your question is, whom do you ask?
I mentioned panelists.
Panelists.
Anyone
panelists.
who wants to address those issues.
There any other question?
Question to Professor FUKAO. In order to analyze productivity, microdata is not available. That is what you deplore. However, the rule of the game could be changed. For example, within the financial statements of companies, it is possible to mandate reporting, or local government authorities, the municipalities. Public accounting is widely discussed, and therefore data could be made mandatory. In the financial sector, in the notes, it is mandated, and therefore productivity of the financial institutions can now be analyzed by information in the notes. Just by changing the rule of the game slightly, Professor FUKAO, data will be available. And therefore, at the Statistics Committee, if you can demand, Professor FUKAO, the financial market, if it becomes complete competition, the private sector will have to disclose those information. The productivity can be indicated in the intangible asset. If there is a financial industry with full disclosure, then I think for the other information, I think the rule can be changed just slightly. So this was for Professor FUKAO.
So thank you for the great talk and discussion. I really enjoyed that. I have a question for the Kiyotaki sensei. And in your presentation, you demonstrated some dynamics of the illiquid asset and the liquid asset. And presumably now the Japanese economy, especially the good Japanese companies, are in a point of the D, like a upper left side. So that they have the liquid asset, but there are some rooms for them to invest. So my question is, I'm just wondering what is wrong with the Japanese economy? What prevents the Japanese economy from moving from the point D to the point A? That is the question. Thank you.
Thank you. So we'd like to get a couple of, of course, a couple of questions. Please.
Any panelists, please, if any panelists would kindly respond. This is about the productivity of Japan. In order to enhance the productivity, what is the bottleneck? As was discussed earlier, the service sector weight is becoming larger in the GDP. Intellectual properties must be converged into market values. Commercialization of intellectual property, it is lagging in Japan. What do you think is the impact of this aspect? Lifetime employment still seems to be the assumption, and professional peoples are not cultivated enough. For a particular profession, there are fewer people who continue a lifelong employment. So what is the impact of this changing practice in the lifelong employment?
And this is just one question to Professor Fanok on the issue of trade governance. You see, what we have seen in the last few years is we're actually losing the multilateral platform for trade negotiations. That is the erosion of WTO centricity. And what we are having instead is the emergence of what we call mega regionals with deeper disciplines, so to speak. And they actually touching the issues, new issues like intellectual property rights and competitions and foreign direct investment. All of them are very relevant to the issue of productivities and innovation, etc., etc. Now, my concern is these mega regionals, TTIP or TPP or whatever, don't you envisage any danger or risk of fragmentation of trading rules between these big agreements? That's my question.
My question is regarding one of the related questions which was asked earlier. We talked about the physical capital, human capital, and social capital in the presentations, but we have not mentioned or touched upon the natural capital. What do you think is the natural capital in defining the productivity, given that now, because of the Kyoto Protocol, there are emission caps on developed countries especially? This is a very important point that we cannot ignore. And secondly, should we not move away from, because this is growth strategy of the world financial crisis, and we know that we have ignored the environment. Should we not, this question is for Professor Jorgensen. So should we not name this conference as KLEMS instead of KLEMS, not KLEMS, which E is for environment, energy, environment, materials. Thank you.
Thank you very much. So please respond. Please respond to the questions. So if you can respond.
Okay, so let me answer what I can answer. The first one is exchange rate in 2020. And difficult to forecast, but I think it depends on investment saving balance. If saving continue to high and investment is very low, and also the productivity will not improve, then we need further cheap yen, I think, in 2020. And income distribution, I think from the viewpoint of Japan, I think the impact of aging on intergenerational income distribution is a very serious problem, not the impact of globalization. And we have a lot of problems from younger generation to elder generation, and we should change that. And
And there was a question in Japanese about non-tangible, the statistics in OECD. I think in the month of February, the accountants gathered and have a discussion on this, but business accounting, they tend to be conservative. So incorporating this would be in the business accounting would be difficult. I think that was the conclusion. Innovation research. There was a survey conducted by NIS NISTEP, and they were trying to incorporate the intangible assets, but they were unable to do so because of the MIC, the Ministry's opposition. And the socialization of intellectual properties, I think Professor Miyaga would be the right person. And professional education. Japan, as you know, from 1950s to 1960s, for engineers who work in manufacturing, there was so much focus on training them. But for those who work in the service industry, especially the sophisticated human resources, when you mentioned professionals?
Because of lifetime employment and rotating around a different department, that environment doesn't really train the people to be very specific, professional. So that was my question. That's right, yes. And my second question was how to monetize intellectual property in Japan.
Well, that's, please ask him. Yeah, Miyaga-san. Yeah. In the case of professional training, I think as up to now, I think, because of under the lifetime employment system, the large companies trained professionals, created professionals, I think. But from now, we need, because the labor market become more liquid, I think each one should get the training by himself. And universities and other educational system must change in that way. Did I answer your question?
I'll be very brief. I think the United States still has the largest number of patents granted, and Japan's number 2. It's really very high, about 50,000 a year. Chinese number of patents is only about 6,000 per year, and it's increased quite fast because it's a low base. But 6,000 is still a long way from 50,000, and a very long way from 130,000. So I think there's no question that China will catch up anytime soon. But I want to make just one comment on the income distribution. It is true that with globalization, what is really happening is that any jobs that can be moved away to a lower cost location will be moved away. Okay, I mean, there's no question. So basically what happens is that it actually makes the income distribution worse. It takes away any jobs that can move away. You leave the jobs that are low paying. But I think one other thing that is actually also causing the income distribution to get worse is really the low interest rate. Because what it does is that it favors people who borrow, right? And quite clearly, and people who don't borrow only get practically no return. But people who borrow have huge returns. So I think that is really another very important reason why income distribution has gotten worse. We are not going to get over that until interest rate return to somewhat normal levels. And the other, of course, is the ICT revolution, but we don't have time to talk about it.
I will answer first your specific questions about how come the liquid investment is coming back, or the temporary employment is recovered, but the permanent employment or fixed investment is so slow to recover. One of the reasons is the uncertainty about the future, and also the irreversibility. So when the future situation is uncertain, and once you invested or hiring the permanent worker, but not easy to fire or decumulate, then the company is hesitant to invest in fixed assets or permanent employment. And the other is actually Japanese case, probably they are investing in overseas. Overseas in terms of by setting up by the children companies' equity and the financial assets. So that's the reason, I think. Concerning social inequalities, I think the public policy's point of view, most important one is try to maintain the civil minimum. If you try to maintain the minimum standard of living, actually that doesn't cost too much. At the same time, the value, the welfare gain is pretty substantial.
We have a timeout, I see it here. I can briefly comment on inequality. Inequality in the environment. We didn't discuss it much, but European Growth Strategy 2020 actually has explicit points mentioned on energy and efficiency, decline of the carbon dioxide emissions, increasing the use of renewables, energy efficiency improvements, and especially there's also a social target, try to bring a stop to the increase in poverty and social exclusion. Now, partly that is related to trade. As Professor Lau was saying, what you see in the economy is a so-called squeezing of the middle, which means that the high-skilled workers actually are increasing their incomes On the other hand, you have the low-skilled workers, which do a lot of personal services, which are very hard to offshore or to outsource, which still require a lot of personal interaction. Their jobs are increasing as well, but they are lowly paid. And then you have to say the middle-educated workers, which wages have been stagnant or are even relatively declining. So that is certainly an issue which needs to be taken care of. We know that trade on average is welfare improving, but clearly it has distributional issues which need to be addressed with additional social policies.
Thank you. So I will please respond shortly.
Yes, very shortly, because I already took 2 minutes and 18 seconds out of your reception time. We can see that on the screen here. So I'll be very quick. First of all, on the trade, I cannot agree more than that multilateral trade agreements are the most optimal thing. You wouldn't be an economist if you wouldn't say that. So, but the question is, if that cannot be done for political reasons, what is second best? And I think that far-reaching trade, regional trade agreements, I hate bilateral trade agreements, to your other point on Japan and US, for example, but far-reaching regional trade agreements are the second best option. I also like to respond on the issue, and I think I'm sure that I'm speaking on behalf of Professor Jorgensen here, to not replace the E in KLEMS with environment. We talked a lot about, in the last few days about natural resources, about land, and about energy. If we measure those well, if we manage them well, if we combine them with intangibles, you'll have an optimal outcome for the environment as well. And then finally, because I have the last word, I would like to thank the chairman for chairing this session.
Thank you very much. Some of the answers may have gone unanswered. However, reception follows. Professor Fujita asking by drinking, communication, responding, asking by drinking. Drinking will definitely stimulate your conversation. Today's topic was very extensive, which was growth strategy after the financial crisis, which means convergence of this whole topic and discussion is simply not possible, but on a long-term perspective, human resources and innovation must be stimulated by all means. A policy has to be implemented with patience. In the case of Japan, policies will have to change. My personal observation is, in each of the countries, as they implement different policies, as Professor Timmer mentioned, trade structure will have to change. Japan's policy have to adapt to the changes. There is a lack of adaptation by the Japanese policies to the changing world. We have had the top global experts of this field to talk about the transformation in the global climate, and countries who would have impact on our economies have been taken up. Policy measures and policy structures will have to change. This has been a very stimulating experience. Ladies and gentlemen, thank you for your kind participation. Professor Jorgensen, Professor Fujita, thank you for your wonderful keynote speeches at the beginning. May we express our gratitude to our speakers and panelists. Thank you very much.